The stock market has been stagnant for the past 18 months, with the Nifty index generating almost 0% return. This means that an investor who invested 18 months ago has not seen any return, and this can be very disheartening. However, it is important to note that this type of stagnation has occurred earlier. Despite the volatility that was caused by COVID, investors who invested in Jan 2020 made 0% return by the end of that year. It seems like being on a treadmill where a lot of work has gone in, but no real movement. The market eventually broke out and made a new all-time high, climbing to 18,400 by October 21 and generating a huge returns for those who stayed invested. This is why it is recommended to have a 5-year time horizon when investing in equity and expect to make a decent return in the range of 12%. This chart here represents the rolling return of an investor who would have invested on any day in the last 20 years, provided he held his investment for 5 years. It covers all possible good times, that is bull markets, and all the worst times, that is bear phases. And look at what the data suggests. Investors who held their investments for 5 years between 2000 and 2023 could have made a maximum return of 23% annually and an average return of 12%. The worst possible return could have been minus 1%, but this occurred only 0.35% of the time. In 60% of the cases, investors could have made a return between 10 and 20% annually. Wealth is made in 12 to 18 months while investing for a period of 5 years. It is important to remain invested because we do not know when these returns will occur. The chart here shows how fast returns can be made when the market starts to get into a bull mode. Now, all this seems random, as if it's luck by chance. So what drives these movements, and why is it just beyond randomness? The answer lies with the stocks in the portfolio. To illustrate this point, look at the 50 companies that make up the Nifty 50. These companies, such as ITC, just as an example, have tens of thousands of employees who work every day to create new products that we buy, or to work at hotels whose services we consume. They toil in factories and warehouses, and we consume their products and services on a daily basis. Same with another company, such as say TCS, where lakhs of employees go to work every day. Across all the portfolio companies and on every single day, crores of employees toil it out. They create huge revenue and profit streams for their shareholders like us, and we benefit from these earnings. The total profits generated by these companies last year was at about 5,70,000 crores. And this financial year, it is expected to be 6,40,000 crores, which means the profits are growing at 12%. Even during the periods when the share prices did not move, the profits of these underlying companies continued to grow. This is similar to a biscuit packet that used to cost rupees 20, but now you're going to get 3 more biscuits at the same price. So the value has gone up, the price has not. Over time, the share price will catch up with the increased earnings. Investing in stock market is similar to a hot air balloon journey, where it takes time to get started. The hot gun keeps pumping in air, and after threshold work is done, the balloon starts to soar. The people in the cage see no change, but suddenly feel the balloon started to soar. Since the portfolio companies and their CEOs, managers, employees keep working to get their products out, the profits keep soaring, and the share price will reflect this in the long run. The share market is run on emotion in the short run, but in the long run, they are a slave to the earnings. That's why markets are like your age. They only go up. If you like the content, please do consider sharing it with your friends. Like it,